Hello traders, good morning, good afternoon, good evening, bonjour, bonsoir mes amis, guten Morgen, guten Tag, guten Abend. For those of you who are new to us, we are the TSTWSYS 008 traders, and our website is www.stochastic-magdi.com. For all trade, we use the 5% money management rules and apply stop loss in all trades. This video is for educational purposes only. It's neither a solicitation or offer to buy or sell any financial instrument. Very, very important. Okay? The title of this video is how to trade the second psychological price level. Few weeks ago, I have recorded a video that we call how to trade, the first psychological price level. If you want to watch that video, you need to go to www.youtube.com/JoeTrio channel to watch the video that we call how to trade the first psychological price level. Today, we are going to discuss how to trade the second, the number 2, psychological price level, all right? To refresh your memory, all right, the first psychological price level is what? Is the low before the last low. How do we know that we have the last low? That's a very good question, all right? We know that we have the last low if the price breaks out of, the declining channel. So the low that we have before the price break out of the bearish channel, that's the last low. So the low before that last low is a psychological price level, all right? Very, very important. Well, we know that we want to work with the market pattern and we want to work with the market principle and we don't want to fight the market, all right? In order to achieve consistent winning trend, we must flow with the market, which means we want to use the definition of the uptrend, downtrend, and consolidation, all right, without fighting the market, all right? In an uptrend, the price will display higher lows and higher highs until the price fails to display a new higher high. So when we are trading the price, though we are using the stochastic, the RSI, the CCI, the MACD indicator, or any other technical trading tool, we are trading the price. The price is the number one indicator. So we must constantly pay attention to the price because all technical indicators will give what we call an indirect signal, but the price will give a direct signal. When we receive an indirect signal, we must confirm it by the price itself, which will give what we call a direct signal. All right? Now, the first question is, what is the second psychological price level? The second psychological price level is the high before the last high. This is the last high. How do I know this is the last high? How do I know that this is the last high? I know because the price from that point break out of this rising channel. This is how I know that this is the last high, because the price break out of the bullish channel. All right. So this is the high before the last high. So I'm going to call out the high before the last high into orange, so you can know the difference between the two. All right. So the last high is the green spot at the top, but the high before the last high is the orange spot here. It is a psychological price level. All right? Very, very important. So we know how to detect the last high, and we know also what is the second psychological price level, which is the high before the last high. Very, very important. Because if we don't know how to detect the last high, we won't be able to know the high before the last high. So it's very important that we note it down, okay? The next question is, what is a psychological price level? I explained to traders in few of my video, and I will do the same thing again today. A psychological price level is a thin, T-H-I-N, thin divided line between a bullish zone and a bearish zone, where financial market participants become very cautious or anxious. Let me say this again to you. A psychological price level is a thin dividing line, between a bullish zone and a bearish zone, where financial market participants become very cautious or anxious. All right? We can also say that the high of the third Elliott wave is a psychological price level because the high of the fifth wave is the last high and the high of the third wave is the high before the last high. You understand? So the high of the third Elliott wave, for traders who understand the wave principle, it is a psychological price level, okay, in an up move. But the low of the third Elliott wave in a downtrend is also a psychological price level. So we can say that, okay, the low of the third Elliott wave in a downtrend is the first psychological price level, or is a first psychological price level. All right, and the high of the third Elliott wave in an up move is also a psychological price level. In this case, the second psychological price level. I want traders to differentiate between the first, the second, and the third psychological price level. I will be recording another video, which will be how to trade the third psychological price level. All right. So the next question is, why is it a psychological price level? Now, at that point in time, as I explained to you, that line is dividing the bullish zone and the bearish zone. All right. So we know that the price was in a bullish channel, which is that telling us that we must give priority to bullish signal. But as the price dipped below the bullish channel, is telling us that the bullish momentum is weakening, is diminishing. All right. If you accept that, okay, is stalling. All right. If you accept that also, okay. So after that, we know that, okay, so where is the bullish zone? Where is the bearish zone? The bullish zone is above the high before the last high, and the bearish zone is below the high before the last high, which is the orange line here. Okay? Next step. Talking about the psychology of trading or trading psychology, all right, what is taking place? In normal bullish progression, all right, in normal bullish progression, the price will display higher lows. You see here, drawing line, it went up, pull back. This is a higher low compared to this low here, okay? So it's a higher low. Now we must have a new higher high. In the uptrend, what we are watching is the new higher high. Here it is, we have a new higher high. Now we have a new higher low. Here we have again a new higher high, but this time from this point onward, the price violated the market pattern, in this case, the rising channel. This is the last high. What usually takes place? I want you to pay attention to this stock. This is Verizon Communication. We are on a monthly chart. The epic is VZ. All right, reality, this is American stock. You can see, if you look on this chart carefully here, the price, pay attention to my cursor, the price went up like this and then pull back. So if you like, we can start drawing line on it. It went up like this, all the way up here, and then it pulled back in 3 more. 1, 2, 3, okay? Now, and then again, it went up, okay, to this point. In fact, I will be more conservative and put it not to the top of the wick. I have a reason for it, all right? When the price displays a new higher high, and it starts coming down, in normal, healthy bullish progression, the high before the new high should support the price. This is critical. This is about the market stable data. The high before the new high is excellent support in an up move. Okay? And also the low before the new low is an excellent, okay, resistance level. We want to understand that. So as the price has displayed a new high after this high here, and it starts pulling back on low volume, bullish traders will be looking for opportunity to buy or expecting the price to find a support around the previous high. Now you can see here the price, you see here, it pull it down and try to go up. That's why I recommend to traders not to enter the trade on a monthly chart, on a weekly chart, but to use what we call a top-down trading method using the trading drill, the setup on a higher time frame, the signal time frame, and the entry time frame, combining the technical and the fundamentals. All right. So if you are trading like old-fashioned traders, you may just buy like here. You see it went down. If you are using a proper top-down trading method, you will know that, okay, it's not going up anymore, and you will pull out or reduce your losses. So the price failed to find a support above the previous high. Okay, but quickly it went back above it. You see here, it recovered and went back above it. Look, It pulled back again to retest the same previous high, and this time it found a support. It did below it a little bit, you see. It went down. This is normal. That's okay. Seeking to retest the previous, the low before this pullback here. You see this low here. Try to go down to retest that level, to confirm that level at a support level. And we have what we call a bullish engulfment. Steve Nissen candlestick pattern. A bullish engulfment right here on a previous high. From there, the price went up. You see now? So our latest high is this one here. So I'm going to move my line there. So price, this was our latest high. Price went up all the way here. Okay, it went up here. Okay, right here. So I will use the conservative measurement again. Instead of going up to the top of this week, I will stop at the closing price here. So after this high, this is the first high, this is the second new high. Now we have a new higher high. As the price pulling back after displaying new higher high, you see here, professional will be looking for opportunity to buy well on the edge or around the previous high. This is the previous high, yes or no? And the price couldn't even touch it. You see here, it pulled back here. You see the wick of those candle. All right, it tried to come, it couldn't. You will see that very often, especially traders who understand the Elliott wave during the third Elliott wave. The fourth Elliott wave, if it's underway, is usually very shallow, okay, because if the third wave is extended. But I don't want to confuse traders who do not understand the Elliott wave principle, but we are talking about the price action or the price move. So sometimes, this is very important for traders to understand, sometimes the price will not come down and retest the previous high, but the price will seek a support of the 50% Fibonacci retracement level of the last price move. What is the last price move? The last price move before this new high is from here all the way here. So sometimes, this is very important for traders, especially those who are using the TST WSY008. Sometimes the price will not come and retest the previous high, but will find a support at 50% Fibonacci retracement level of the previous price move. The previous price move is from here all the way up here. So the 50% Fibonacci retracement level, look at that. Look at that. Can you see the 50%? Can you see on your chart? It's this line here. Isn't it gorgeous? So instead of retesting the previous high, be aware that sometimes if we have a strong progression either in the uptrend or downtrend, the price will seek to find support on the 50% Fibonacci retracement level of the previous move. Look at the pink line. That's the 50% Fibonacci retracement level of the previous move. Beautiful, isn't it? All right, very exciting. Yeah, here, all right, if you are TST WSY008 trader, pay attention to this video. If you have any question, please get back to me, all right? But if you are not TST WSY008 trader, and you ask a question that we cannot answer, I cannot reveal, confidential material to traders. I'm not allowed to do that, I can't do that. But if it's a question that I can answer, I will answer it openly. But if you ask a confidential question, I will not be able to answer it. Sorry about that, So you see here, pull back to the 50% instead of coming down all the way to the previous high. But what we want to understand is that this is a market stable data. The previous high before the new high usually should support the price in an up move. On the downtrend, the previous low before the new low should be able to suppress the price, all right, which means will become a resistance, pushing the price further down. This is what we want traders to understand, and they should be able to make excellent trading and investment decisions. We don't want to fight the market. We want to work with the market. So here, it couldn't come here, but it stopped on a 50% Fibonacci retracement level. Beautiful. I'm going to remove my 50% Fibonacci retracement level. Now, the price display now a new high, yes or no? And then you pull back to the 50%, trader responded, bullish traders bought it again, provided that the fundamentals are solid. You want to do the Google Asset test, check the balance sheet, check the cash flow, check the sales, check the management, check the market share, check the future prospect, use the trading triangle, all right, pay attention to the economy news, all right, and if you are satisfied, game on, all right, and then the price from here, went up again to display a new higher high. So this was the previous high, price display a new higher high. As the price display a new higher high, we will expect the previous high, which is here, to support the price. Can you believe it? Exactly that. We are on a monthly chart. You drop it where it stopped on the previous high. Beautiful, isn't it? Right here. Look at that. Nice. So as long as we are in a rising channel, we can expect this to take place. But we must use a top-down trading method. If you are a fundamental trader, you do your fundamental verification, you do your due diligence, you are satisfied to buy, but you want to buy at the right price. Don't just buy because the fundamentals are excellent. You want to buy at the best price, okay? You know that, okay, something is valuable, whether it's gold or whatever you want to buy, but you don't want to buy it at any price. That's crazy. You want to buy it at the best price, better at a discounted price. That's why when we want to buy, we will expect the price to pull back. We don't want it to be going up or become too expensive. If it's going up and we want to chase it, at least we want to buy it at a fair value. So here it is. They bought it here on the previous high. You see, very beautiful for swing trading, yes or no? And, by the way, the TSCWSY008 is specialty swing trading. So from here, the price went up and displayed a new high right here. So as it's pulling back, what do we expect? We are expecting it to find a support on the previous high, which is the orange line here. But it did not. People tried to buy. So, in fact, if try to find a support, that's why it's so important to use the top-down trading method. You can see that trader tried to buy here. They are not stupid. It's not wrong. But this time, the price, you see, it just went up, phew. Even went into the previous high. You see, it violated, this point was a support level here, even crashed through it before recovering. And this time, as the price tried to go up, it's suppressed here. So this previous high, that's supposed to be a support in a normal bullish progression, now has become a resistance level. We must sell. So, to summarize this blah blah blah, okay, if you like it, all right, if you like this video, okay, give us a thumbs up. If you don't like it, okay, give us the thumbs down. It's very important for us to know whether you like it or dislike it. It doesn't matter. If you have any comment, put it below. All right, it will help us to improve, okay, our tutorial. All right, and also, if you want to share it, okay, share it on Google+, Facebook, or Twitter, okay? This is not a confidential video, so traders can share it with, okay, their friend. Okay? So, now, this is supposed to be a support level, the previous high, has now become a resistance level because as the price dip below it tries to go up, it stops here. You see this inverted hammer here? So there was a bearish move, and then we have a rally to retest. So break below the previous high and retest it. So we are on a monthly chart. This top candle is the retesting candle. This is the language of the price. Break below, retest, break above, retest. But we want to know where is the best place to enter the trade and what is likely to take place. All right. So here we have an inverted hammer, bearish inverted hammer, not even a bullish inverted hammer, bearish inverted hammer. And from there, they sold it. The point I want to make to you, from this point onward, the price break below the channel, alerting us that this is the last high. This is how we know that it's the last high, because it came out of the channel, so this is the last high. So now, we will expect the price to dip below the previous high, and the previous high to be converted into a resistance level. And here it is, after this candle here on the monthly chart is closed, the bearish traders start dancing. All right? This is a bearish party. They sold it. So, 1, 2, 3, 4 months, they sold it big time. All right? So, the second psychological price level is the high before the last high. I want the trader to understand that carefully. What is taking place? Whenever the price displays a new high, a new higher high, okay, and it's pulling back onto the previous high, the bullish traders would like to buy. It's normal. We go into their mind. If we go into their mind, okay, you understand now? They will be willing to buy, and they try to buy. You see, if you went all the way down here, are you with me? This green candle, you went all the way here, but you see they bought it quickly back up. because they think that the price will go up again. But what these people were doing here, they were violating the market pattern. They should wait for the price to return inside the channel. But you see how the green candle closed on the edge of the lower part of the rising channel? Patience is very important here. They were aggressive buyer, they bought it. But the bear who were observing what is taking place sold them down. Two, the bull did not believe that this is a double bottom pattern. But you want to be bullish, you want to be bullish in a rising channel. If you want to be bearish, you want to be bearish in a declining channel. If you are selling, for instance, you are selling on a 50-minute chart, or you are selling on a 5-minute chart, or you are selling anywhere else, but you are selling, okay, anyhow, without respecting the market channel, without using the trading drill or the top-down trading method, it's like you are fighting the market. And we don't recommend that to traders, okay? Don't fight the market, don't fight the market, okay? So here we are. So now the validation of the previous high at the value resistance level will allow us to look for signals. So at this point, this is the setup. After this candle here is closed, this is a bearish setup at the second psychological price level. The best bearish setup takes place at the second, around the second psychological price level. The best bullish setup, okay, takes place around the first psychological price level. All right, but we will use a top-down trading method, okay, to participate in the market. If you are a fundamental trader, we want to enter the trade at the best price. All right, if you are an investor, you want to buy it at the best price or sell it at the best price. What they have said to me when I started trading first, they say, George, you must buy high. I said, what do you mean by that? You say, whenever you want to sell, the price must go up first. And it goes up fast and start going down. Okay, that's what we said. They said to me, don't sell it if it's going down. Be careful if you are selling if it starts going down already. You want to sell on the edge. Referring traders back to our website, the trading on the edge. Okay? So price went down and this level was confirmed as a resistance level. I want to highlight to traders also that, okay, bearish market cycle usually take place on or near the second psychological price level. Okay, this is so important that you didn't get it. I'll say it again. Bearish market cycle often take place on or near, okay, the second psychological price level. Bullish market cycle often start from the first psychological price level. We will not assume anything. All we know, we want to follow the trading drill so we don't come into the market too early or too late, or we don't buy at the wrong price, but we want to buy at the best price. When we buy something, we want to manage the trade. We don't want to leave our money on the table and it's being taken away from us. We are still in charge, we can control it. The signal fails, come out. Just, okay, go to the bathroom, wash your face, forget about it, wait for the next, okay, best setup. All right, it makes sense. So as the price was approaching the high before the last high, bullish trader we know going to their mind, okay, we know that they will try to buy. As they are buying, we are watching them. Okay, if it's going to continue, we are on a monthly chart. We can go, for instance, on the 4-hour chart. The price must be in a rising channel from this point and start going up. But if we don't see that, even on the 4-hour chart, and start coming out of the 4-hour chart, we know that game on. All right, game on. So price went down and then retested here. Price. You see how this candle went all the way to retest it again? First time here, they push it back to retest it. But now, again, because the price was still above, okay, the previous high, that's what I'm saying to you, this is a psychological price level. That's why I say to you that a psychological price level is a thin dividing line between a bullish zone and a bearish zone, where, okay, market participants become very cautious or anxious. All right? So as the bulls are buying here, they don't want it to go back below the previous high because they know it's a psychological price level. And if it goes below it, they will come out, they will close their trade. They will become anxious. They don't want it to go below it. They want it to stay above it. All right? As long as it stays above it, they can continue to buy because they don't worry too much because they know that they have an excellent support. So they become anxious as the price is supposed to start going up here. They see it start going up, and then it start going back again below the psychological price level. They don't like it at all. They want to be out. They become anxious. Okay, they become a bit disappointed, and they don't like what's taking place, and they become a bit afraid. That's the right word. They fear. All right. On the other hand, the bear that are waiting on the edge, the bear also don't want to sell. Okay. Here, so those who are selling on the edge here know that there is this psychological price level. They don't want it to find a support here. They are also anxious. That's why psychological price level is a thin dividing line between a bullish zone and a bearish zone, where market participants can become very cautious or anxious. As the price find a resistance here now, this candle is closed. The bulls will not try to interfere with the bear. In fact, those who were buying before will close their trade, so which means they will have to sell, all right? And the bear that want to sell will set together, creating a beautiful, strong, bearish momentum. All right? So it can be very, very tricky to trade around the psychological price level. So the sentiment instantly is bullish above and instantly bearish below a psychological price level, because the bulls that are buying above the psychological price level do not expect the price to go below it. And as the price dip a little bit below, they become very anxious. Some of them will close their trade instantly. Those who are very, very risk averse, they will close their trade. They say, I don't like this. It goes below that support level, and they don't like it. Here, as I show you here, the previous high, which is this one, the price couldn't even touch it. This is a beautiful setup. The bull will be rejoicing, and the bear will be scared. The bear will not try to sell here. It will be completely crazy. In fact, the price came out of the channel a little bit, but you see, it closed on the edge of it. You see, it went back again below, but the bull pushed it back inside. It's going to go up. All right? As the price going up, which is important, trader must understand. So suppose you are here and you are TSCWS as your trader and you buy it. Okay, you buy it, it start going up. The price going from one support level to the next resistance level. So as it's going up, what is your first target is this high here. Do not ignore it. The price can find a resistance here and come back down, displaying double top. The same thing here, as you buy here, is going up. Your first target is this high here. So as it's going up, you see this candle here. It went up this monthly to this high, and some traders sold it. Okay, you see this candle here. Okay, this candle brought it. People bought it here, which is normal. As it's come here, they came out. It's not bad to take profit consistently. In fact, I think it's the best way, to manage the trade and to enjoy the market. Sometimes, some traders, depending on their risk tolerance, they may let it run. But you have to control the risk. Either you may use a hedging position. Okay, you can hedge your position to control the risk. If you're afraid, all right, you can use option trading strategies. Okay, all right. So they sold it. So remember that when you buy here, the first target is the previous high. On the other hand, if you are in a downtrend, and we sell, our first target is the previous low. Then, so here you see it came, people sold it, it pulled back. Well, you see where it stopped? The 50% Fibonacci retracement level of this candle. The body, you see the body of this candle? Do not pay attention to the wick, the body of this candle. If we use Fibonacci retracement level, it went back up to here, as it's pulling back, it stopped on the 50% Fibonacci retracement level. Another psychological price level. It makes sense? It's also powerful, okay? Ladies and gentlemen, this is about how to trade the second psychological price level. The first psychological price level is the low before the last low. How do we know the last low? We know the last low when the price break out of the declining channel, all right? The second psychological price level is the high before the last high. How do we know the last high? All right? The last high, the price will go below the rising channel from the last high. Right here, this is the last high. Price went below the market pattern. All right? In normal bullish progression, the price will seek a support around the previous high. So after displaying a new high, the price will seek a support near the previous high. If the market is very, very bullish, the price will seek a support at the 50% Fibonacci retracement level of the previous price move. The price does not go up forever. Traders should be aware of it. Financial instrument can become overbought. At that point in time, it's pointless to try to buy each time the price coming near, okay, the previous high. Traders who understand the area wave patterns will be able to filter out, okay, a false, a bearish setup, okay. A psychological price level is a thin dividing line between a bullish zone and a bearish zone where market participants become very cautious or wary, okay? I have also explained to you why it's a psychological price level, because just above that line, okay, the market is bullish and below it is bearish. And the bullish trader do not want to trade below that line, and the bearish trader do not want to trade above it. If they are trading, if the bearish market participants are selling above that line, they are very, very anxious, and they will be happy. You see here, as the price went there, and it closed below this level, oh, this bear will breathe a sigh of relief and say, oof, nice, close below it. Now they want to sell again, so they will increase their positions. For TSCWSY's usual traders, it's a simple trading tool. It's not a software, all right? Very simple. But we want to work with the market pattern, and we want to select the best entry point. We want to catch the best cycle, bullish cycle. Often we start from the first psychological price level, and also bearish cycle. Very often we start from the second psychological price level. In the next video that we'll put on our YouTube channel, we'll be talking about the third psychological price level. What is the third psychological price level? How to use the third psychological price level? Stay tuned. Very soon, I'll be recording another video. I hope you have enjoyed this video or have learned something from it, okay? And we make excellent trading and investment decision. But remember, when one is trading, there's also risk. We must control the risk. We must manage the risk, all right? But at the end of the day, we cannot afford to use the technical alone. One must combine the technical on the fundamental, go into Google Finance, Yahoo Finance, and the Forex Factory for traders that are trading Forex. This video is suitable for day traders, swing traders, and investors. Until the next time, enjoy yourself and be very happy. We are the TSTW SYS 008 traders. Happy trading to you all.